Welcome back, everybody, to Magnolia on Money, where we discuss everything financial from the economy to retirement. I'm Ed Cox with Magnolia Wealth, and today I wanted to push out a video on Monday, which is not normal. Normally, we're doing them towards the end of the week once we kind of see what's happened in the market that week. We will probably still put one out at the end of the week about what the Fed decides to do with the Federal Reserve rates. But Friday and through the weekend, we heard a lot of news about this bank in Silicon Valley, and I wanted to bring the information to you that what we know right now and kind of shed some light on that. So what's going to happen to the bank, the people's money that people that had money in the bank, the investors of the bank, and then why did they get in this position? How does a bank that's that big, 16th largest bank in the U.S., how do they get into this situation where they kind of have a run on the money at the bank? So let's dive in. So Silicon Valley Bank, what is it? Why is it in trouble, and what does this mean? So let's look at what the bank is. So the bank, as it states in its name, was designed for Silicon Valley startup companies. And most of these are smaller venture capital companies. They have really big ambitions to go out and create these great products or services, technology mostly, but they have less secure financials. So they don't have a whole long track record we can look at, or the banks can look at to see, how do we lend money to a company that's a fresh startup? They have a great idea. Will it mature and become a company that can actually pay maybe the loans back or any of the debt that they have? So it's very concentrated. So Silicon Valley Bank, it's very concentrated in one industry. And people are asking, is this like most banks? No, it's an outlier for sure. The fact that it's very it's very concentrated in one industry and in one section of our country. Unlike the big banks, the JP Morgans of the world, the Bank of America, they're way more diversified. They're a bigger bank. This is I'm not going to say it's a one-off, but it's a very specified niche market for a bank. So it makes it really different than what you see locally or anything like that. Saying all that, it has much higher risk. So when you concentrate your investments in one area, one type of market, it brings on more risk. So let's look at really what happened with the bank and why it is in this, this predicament. So this is the revenue of the bank. You can see in 91, where this graph starts, we kind of get this, normal growth pattern of a good mature or company coming into maturity. And then right about 2018, 2019, okay, somewhere in here, we really see the money coming, or the revenue of the bank going up. A lot of this has to do with what happened in the tech sector during COVID, right before COVID, but mainly during COVID. You can see between 19, 20, 21, when, the tech sector was really taking off, this bank was really bringing in a lot of money. So although that's what you want as a bank, that brings challenges as a bank as well. So what do we do with all of this capital? What do we do with all the money that's coming into the bank? Well, one of the things that this bank, and where they made probably their biggest mistake in this whole situation, was as money was coming in, these are the U.S. Treasury securities. So money came in mostly between end of 2019 and 2020. So they were investing a lot of money here in long-term Treasury bonds, not short-term. Okay, so you're having them purchase in the meat of when the U.S. treasuries were very, very low. So they were buying long-term treasuries when rates were really low. So what happens? The Fed comes out, we're going to start raising rates. The rates go up. And remember, when rates go up and you're holding a bond, the price of the bond typically goes down, especially the longer the bond maturity. So when you're holding a 10 or 20-year bond, the risk in a bond is interest rate risk if you cash the bond in before it matures. So the bank never thought we're going to need to cash these in. They're thinking, we'll buy this 10-year treasury, we'll let it mature, we'll make a spread between what we're paying their customer and what the treasury is making, and we'll pocket a good profit. The problem is the Fed started raising rates. So now they're holding a bond paying less interest than we can go purchase in the open market because they bought it down here. So to sell their bond, they have to discount the price. When they discount the price, they're losing principal value. So when the bank was receiving most of their funds over the last few years, they were purchasing these bonds at a low rate. Rates jump up, and then they had a little run on the money at the bank. So they had a few big companies come in and take some money out. They didn't have enough liquid cash there, so they had to sell some of these long-term bonds at a big discount. Then people started noticing negative balances on the financials of the company, of the bank. So they start seeing, wait a minute, the bank's not doing as well as we thought it should be doing. So what's going on? So then people start to pull more money out. I don't like the way this bank looks. Then it hits the fan and the news gets out that this bank is in trouble. The price drops dramatically in stock price, and people start to do what is called the old run on the bank. They had to run on the money, where people went and said, looks like this bank's not doing well. I don't want my money there. I'm going to pull it out. And when they did, the bank could not keep up with the cash available needs. They were having to continue to sell these treasuries at a discount and continue to lose more and more and more money. And that's where we find ourselves today. So unlike a lot of banks who would be purchasing treasuries in shorter time horizons, especially when rates were as low as they were, they would be purchasing, 1 month, 3 months, 6 months, 12-month treasuries. And even if they did go longer, they would be laddering these investments, so they came due at different times. Very specific bank, very different than what you see in most banks. So what now? So the president came out this morning. Everyone has been made whole who had money on deposit, and also did not matter if they were above the 250. So people say, well, how is that the case? FDIC insurance is only up to $250,000. They're able to make in certain situations, FDIC is able to go above and beyond that if they think by not doing so can cause harm to the economy. And at this point where we are with, the Fed trying to raise rates and everything that's going on, they thought it would be in the best interest of the country to go ahead and cover all of those and let people know, look, your money's safe at the banks. Remember, that was one of the big issues back in the Great Depression. People lost faith in the banks. And so they do not want any of that happening, especially when this is kind of one of those weird deals with a bank that's in a specific area. And then the Signature Bank that you've just heard about was a cryptocurrency lending bank, for those customers. So once again, if you've heard about Signature Bank, which is another bank that the FDIC stepped in on, same situation, small, very niche market, and very risky in their portfolio. FDIC, Treasury, Fed said that the taxpayer will not pay for this. They'll use the FDIC insurance and the special assessment on healthy banks to pay this back. The good thing that I saw was this. I really think this was good that they did not bail out the investors in the bank. So somebody who owns stock in the bank that took a risk, just like everybody else does when they make investment decisions. The federal government is not bailing out those stockholders, which I think they shouldn't. That was a good move. So that's kind of where we are now. How will this affect the overall economy? I really don't think it's going to have much impact. They're saying that the Fed may not even raise rates this week due to this happening with the banks. We'll wait and see. We'll come out hopefully the end of the week and we can talk about that. But I hope this helped. It's one of those things. I wanted to throw it together and get it out there to you real quick to answer any of your questions. But I don't see this really having a big impact on the economy from we don't have a systemic bank problem. Most banks are in really, really good shape. These just happen to be some of those outliers. And when things like this happen, when big moves are made, like the Fed has made in interest rates, the ones that are out on the edge, they get chopped off. So sometimes this happens. They were doing really good when everything was in their favor, and then when it turned and went the other way, they were kind of left out in the cold. So I don't see this happening with mass amounts of banks across our country. But I do think this will affect the Fed's decision this week, and we'll see what happens. But I hope that helped. Once again, God bless. Y'all have a great week. Don't worry about this stuff. It will happen. Things like this will continue to happen in our economy. We just want to be here to help you understand it a little bit better. Take care. Have a great week. Bye-bye.